Hi, folks. Wedell here. I'm Chief Investment Officer at RFG, and we thought we'd come to you today with a little bit of an update on SVB, Silicon Valley Bank. Certainly a story that's dominating the headlines, and we figured we'd come to you with a little bit of an update and let you kind of know what's going on. So on March 8th, Silicon Valley Bank basically announced that it had lost a meaningful amount of money in its investment portfolio and was seeking to raise a little over $2 billion in additional equity to help shore up its equity account based on the losses that it had in its investment portfolio. That equity offering then subsequently failed, and it basically triggered what in the industry is known as a run on the bank. This, for anyone who has seen It's a Wonderful Life, which is one of my favorite movies, you will understand what a run on the bank is. But basically, it's a scenario where a lot of depositors look to all pull their money at the same time. When that happens on a bank, banks rapidly become insolvent. They rapidly become unable to meet the demands of depositors who are all simultaneously withdrawing. And so by Friday, March 10th, the bank had actually been put into receivership by California regulators under the protections of the Federal Deposit Insurance Corporation, more commonly known as the FDIC. Now, first and foremost, should you be terrified? The answer is probably not. None of the custodians that we work with keep any client cash on deposit with SVB, so there's nothing really to worry about there from that perspective. And the SVB itself, its equity is now worthless. It's been put into bankruptcy, but it represented 0.02% of the S&P 500 when it went under. So I don't think anyone's going to notice any type of measurable hit within their investment portfolio as a result of SVB's collapse. Now, to understand why the news cycle is so caught up in this, you kind of have to understand a little bit about something about how bank runs work, along with the fact that they are really, really difficult to stop once they get started. So first, let's give it a little bit of a background in banking 101. All banks at their core, whether you're SVB, whether you're Regions Financial, whether you're JP Morgan or Goldman Sachs, all banks at their core basically operate on the same principle, which is I take in deposits from depositors, generally in the short term. So that's, checking accounts, savings accounts, certificates of deposits, corporate money management programs, all of these things. I take in these short-term deposits. And then I take that cash and I turn around and I lend it out long, right? So, I'll take those savings deposits and I'll turn around and repackage that as like a 30-year loan and loan it out so that somebody can buy a house. And the individual who bought the house pays me 6% interest on the loan, and I turn around and pay 3% interest on the short-term deposits that I use to fund the loan. And I keep some amount of cash on hand to meet the normal inflows and outflows of the bank, because you can kind of predictably tell if I've got this much in deposits, how much money comes in and how much money goes out on a daily basis. So keep a little bit of cash in reserve to make sure all that happens. All of that works swimmingly well, and the bank earns a profit on the spread between the 6% that it loaned the money out on and the 3% that it pays out to investors, to depositors, basically. All of that works swimmingly well until all of your depositors decide that they want their money back at the same time. And normally what happens when this occurs is the bank runs out of cash to be able to meet the needs of all those depositors or the demands of all those depositors. And a regulator has to step in and say, okay, everybody stop. We're going to shut this whole thing down and we'll liquidate, all of the mortgages on one side, and we'll take the proceeds from the sale of all these investments and we'll pay off all the depositors on the other side. But you just got to give us a couple of days to make that happen. The thing about runs on banks is banks are fundamentally built on confidence. When you deposit money at a bank, you typically are not at all worried that when you come back a day later or a week later or a month later, that you'll be able to get that money back. And the second that there's a whiff of confidence of, oh, wait a minute, maybe I won't be able to get that money back, it encourages you to withdraw your deposits, right? Something that in today's day and age of digital banking is literally as simple as a few mouse clicks to open up another account at a different bank and then initiate a transfer from one bank to another is literally something that can be done all online. And a lot of people have multiple different banking relationships. So you don't even have to set up a new account. You just transfer money out of one bank and into another, or into an investment account or wherever it might be. And if you're at all worried, there's this, well, why wouldn't I? Right? Like, I'm not getting any real benefit by leaving my money on deposit with this bank that I might be questionable about. Even if it's just the slightest of question, I should probably go ahead and move all of my money over to here, to this bank that I'm convinced is safer. And the second that starts to happen, it's basically impossible to stop, because you only really need, 5, 10, 15% of depositors to feel this way before you have a real serious problem on your hands. As a result, the run at SVB was impossible for the Fed to stop. And the Fed basically stepped in over the weekend and did a lot of things to make sure that this run would not continue on any other small bank that the news identified as maybe being slightly weak. If CNBC points to, another bank out there and says, oh, it looks like this stock price is under pressure, that might be all it takes to start the run on the bank. And the Fed wanted to come in and prevent that. So they did a number of things, probably the most significant of which was guaranteeing all of the deposits at SVB, basically saying that the $250,000 FDIC limit doesn't apply anymore. Everyone who had money on deposit with SVB will be made whole. They are using FDIC reserves in order to make that happen. They also stepped in and changed some of the banking regulations with which basically securities that the bank owns can be presented to the Fed to get cash. Did a bunch of other things to increase available liquidity on the bank's balance sheets, which hopefully should stave off, a massive slate of runs on other banks around the country, with the Fed coming in to basically flood the system with liquidity and ensure that we don't have a little mini banking crisis. There are a lot of people that are out there drawing comparisons between this and the 2008 banking crisis. And I just want to be very clear about what we have going on. At SVB, or Silicon Valley Bank, the losses seem to have stemmed from long duration treasury securities that the bank bought when interest rates were very, very low, which then, because interest rates are a lot higher now, they've taken a principal loss on. And anybody who owns bonds in their portfolio through 2022, you guys know what that feels like. You can see that loss. The thing about this is, in 2008, we had an entire wave of securities around subprime mortgages and repackaging of subprime mortgages and tranches of securities that were essentially worthless. And that's not the case here, right? Bonds have depreciated in value, don't get me wrong, but unless you're substantially questioning the credit quality of the federal government, which we aren't, there's really no question that the underlying collateral of those bonds will be paid off at par at the end of their duration. So really, this becomes kind of a mark-to-market rule and or a loss that you have to absorb. But then, hopefully those securities will be worth par at the end of the day. If they're not, we have bigger problems. Would just note that one of the steps that the Fed took over the weekend is to basically start treating all federal government securities as worth par when presented to the Fed window to exchange for cash. So one of the things that they did to basically help shore up bank liquidity is basically enable banks to give those back to the Fed and get par back for their loans. So that is what's going on out there. I think it'll probably be successful. The Fed is indicating that they are going to make sure that we don't get a series of runs that are out there. They're going to do their best. And the Fed is a very powerful institution that it has been said by many people you should not bet against. And I would probably count myself in that camp as well. So last but not least, how is the market reacting to all of this? Well, we are stuck in the classic good news is bad news is good news news cycle. There's obviously a lot of fear about what's going on in the banking sector, a lot of turmoil. Anytime you have volatility, this type of volatility in the marketplace, you get that. But, on the rate side, there are a lot of people that feel like the Fed may not increase interest rates given the turmoil that they've seen in banking. And so maybe that Fed funds rate comes down. And as we've talked about before, when interest rates go lower, equities generally go higher. And we've seen a little bit of that today in the market reaction to the news from over the weekend, from really over the past 5 days, with the market rallying a little bit on this notion that maybe interest rates don't have to go much higher if the Fed's worried about, putting pressure on financial institutions. So with that, as always, if you have any questions about this or anything that we talk about, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.